I'm going to be going over this morning's really nice Nasdaq short right at the open. So you can see it's the 16th of July, Wednesday. This was PPR release at 8:30. Daily, just for context, consolidating. And the previous day we ran up, hit the 220s, which was the level I was looking at, and broke down. And I'll just set a brief groundwork as to why I had the narrative and bias I had. So we have these levels such as 23k. Obviously it's a very major institutional kind of level, which I'll put a line on. So we've got this level here. And when we reach an institutional level like this, I like to see us reach 100 and 200 points on either side of it. I see that as the range of us sweeping liquidity out. So if you imagine people who want to be short below 2300, they might have their stop loss up just a bit above 23,100 or also 23,200, which we went and swept. Same kind of thing on the downside. We have 100 points below down at 22,900, about here. So you can see us ranging kind of into that level. And then 200 points below is down here, which we made perfect equal lows on at on Monday. And the only time we've swept that since hitting 23k for the first time at all-time highs is back here. We had a brief dart below the 800 level, and then since then been ranging just above, consolidating. So I'm expecting us to likely draw down to this level at some point. And what really adds into that as a nice confluence, I'll just turn off position breaks, is the fact we have this bullish order block down here on the 4 hour, which we have not yet hit. So an untapped bullish order block with liquidity engineered right above it, slightly higher low, relative equal lows engineered just above it as well, and above that 800 level. So yeah, it makes a lot of sense for us to come down into this area to accumulate all the sell side before hitting high. So that part of what made this short such a good trade today is that we had this bias and narrative behind us as well, which was in the same direction of the trade. And the reason I say in the same direction of the trade is because the framework I was moving is independent of the bias and narrative. And essentially what the framework is if we go to RTH, actually you can see what's happened anyway. We sold off, but I'm going to replay before 9:30 and now show you what it looks like. So this is I'm going to go to the 2 minute on the right just to make it a bit cleaner. Then we've got the 15 on the left. So obviously the previous day we had these large rally up there, another rally getting above the 23,200 level, consolidating at a premium all day, trapping long. So whoever's been chasing all these rallies and this breakout above 23k, they've all been traps long. And further to that, this is the 1800 level, 1800, so there's the new day opening gap right there for this particular day. And as you can see, we dropped down to 23k and barely dips below it at all, basically made perfect equal lows there, and then an enticing rally away from 23k. So that really sets the narrative that, okay, traders are going to see this as strong support, 23k being strong support. Now we're enticing longs, consolidating at a premium all day. Everyone's getting long. Then going down into the close, what happens? Well, we've got 4 p.m. just here. That's at 23k level, which I'm going to actually leave that green line on it just to make it stand out a little bit more, but I'll make it a bit smaller. So we've got 4 p.m. selling off, and if we jump to regular trading hours, sure, we traded below it overnight, but during regular trading hours, this is where we ended up. We ended up just short of it. Then if I print the very next candle, this is the 9:30 open. Actually, before I do that, I will quickly show the other things that gave me my bias. So the 2 minutes now on this side. So sure, we sold off overnight, started pulling back. It's lagging like crazy, but then we have this scenario right here. So one of the things that I've observed recently is that we can identify original consolidations based on the close proximity of multiple opening prices. They can be on, I'd assume, multiple different time frames, but in this case it's on the hourly chart. We have 5 a.m. and 6 a.m. opening at the exact same price. And if I jump across to ES real quick, you can see the exact same thing, but it's even more so at the precisely the same price. 6 and 7 a.m. same price. So we'll jump across back to NASDAQ, and then ES, we've got these perfect equal highs, which you just saw sitting up at 6,300. So 4 perfect equal highs is 6,300. And yeah, so on NASDAQ, we have those opening prices. We then have this rally away from it, and then a short-term low put in here. So that's your short-term low. There's your intermediate term low, and then that makes your first stage of the market maker model. So original consolidation, and then first stage. We then have the second stage at 8:30, which fits the time of day and the part of the market maker model. We were expecting volatility and a very fast move. 8:30 provides that, confirming that this is a very nice second stage, and you can just say second stage of that. So at this point we have first stage and second stage of the market maker model. We're expecting, on the regular trading hours, we know that this is our draw down at 23k. We're also above the midnight opening price, which is just here, like that. And so we're at a premium to midnight. We're at a premium gap open as well. We're going to be opening up here, and so all the way up at this premium. And then on top of that, we're also above the 8:30 price, which is down here. So multiple premium opens. If I mark that up as 8:30. Not sure why that just disappeared. There we go. Or not. Ah, here. So multiple premium opens. We have the premium regular trading hour gap and the premium above midnight and 8:30. And we have the framework of the market maker model as well. Now, one of the frameworks that I use as well that was also part of this is regular trading our trailed stops framework, which is essentially when we get a premium gap opening, what I'm looking for is for us to, so let's say we open here, I'm looking for us to, with a gap up, looking for us to, maybe injure a little low like that, entice longs, and then sweep that out. And I'm looking to target that low, seeing that, okay, we've got a gap opening. Everyone who is tripped in long, they would need a place to trail their stops. Then we provide them that place with the narrative suggesting that, okay, this is going to be a good place for people to trail stops, and then I want to attack that. So now I'll jump straight to this chart. So we're on the 1 minute on the right now, and I'll start playing forward from 9:30. So there's our opening candle. One of the things I was looking at as well is, as I mentioned, ES had those perfect equal highs at the 300, so I wanted to see that get hit ideally. And that also has now provided us SMT as well on the highs. I wanted to see that get hit. It did get hit, so that wasn't a worry for me anymore, and I was just focused on NASDAQ. And as we can see, we opened up. We initially had a rally and put in a pretty bold looking candle. And when I was watching the replay, I noticed an observation I've seen in the past where we only flipped bearish in the last 5 seconds of the candle, and a lot of the time that does actually put in the high. This isn't catching up, but don't really need that chart just yet. Well, I do want it for the 15-second chart. Here we go. So yeah, well, you can see the regular trading hours anyway, that we're targeting these lows in the sell side, the 23k level, and these opening prices. I'm going to put this back to regular electronic so we can get a bit more context. So yeah, so I'll play it forward and talk through what I'm looking at and what I was thinking. So right off, have that rally up, exactly what I'm expecting us to start displacing lower. We've got the smart money reversal, which fits in with the market maker model framework we put down here with these original consolidation, first stage, second stage, etc. And this is where I kind of underperformed today, is that although I knew what I was looking for for us where to go and things, I didn't have any plan on how I was going to actually get in, and for that reason I let everything slip me by, and I just executed very poorly on the opportunities I did end up taking. And part of this review is I just wanted to go over and observe, like trying to think through how I could have done it differently so that I could actually capture this, because it's kind of dumb to have a really high conviction we're going to go from exactly here to down here somewhere and then not be able to get a single bit out of it. So yeah, so initially rallying out, taking out these highs, really nice, got that signature with a 5-second flip bearish as well. As you can see, this is all balanced from this high down to this low. We remained in that range the whole time. So all of this is balanced, and any inefficiencies left in here, we don't expect to need to get visited. And certainly not this high one. And you can see on the 15 seconds that aligns with this gap right here. So expecting that to likely stay open. And then we continue lower. So straight away, I can see, there's a lot of volatility. And when I'm watching this, I usually prefer not to go down to the 15-second chart. But that's just because I haven't found consistency on the 15-second chart. But then in saying that, I also haven't been consistent on other time frames as well. So there's probably a time and place to use the 15-second chart, and maybe when we have a very abrupt move like this, it would make sense to. But observing what happens on the 15-second and the 1 minute. So already we've been selling off quite a bit, but we haven't really done much that indicates that we've been enticing everyone to move their stops below the low. And I think that's part of the thing that tripped me up a bit, is that because I was looking for that framework, I was potentially ignoring some of the opportunities ahead of that framework being present. And that framework today was pretty subtle, which I'll demonstrate in a moment. So now we've got this wick. We're expecting this to remain unfilled ideally. So I want to measure if we have a willingness to stay below this wick CE. And then at the same time, I'm watching how we've got this very long wick up here. And I'm expecting that we shouldn't come back into this wick. And if we don't, then we have a signature that I call the long wick plus displacement, where we have a wick that's left unfilled, followed by a fair value gap that indicates that we're very heavy. So playing forward, you can see that we did respect that wick, and then we get this big move, and then already we've hit the midnight open and the 8:30 open, and that would have been the place to get in. Is expecting this to remain unfilled. We have this long wick, and I'm confident that we should draw lower towards these lows. But I think what really threw me off was just because I was waiting for maybe even a bigger up-closing candle and more narrative that suggested that everyone was trying to get long. Where in reality, we already have that narrative. Everyone is already trying to get long. Everyone's buying this bull flag after the bullish PPI news. And yeah, it's hard to figure out how I'm going to be consistent with executing a trade when it's moving so fast. And like, it's so easy just to miss something or make a little slip up. And I just feel like I have to be super accurate. But in any case, we still hadn't hit 23k, so I still thought we'd go down there. Then we have SMT on these highs as well. There was another nice confluence, which isn't loading. So if we look at the ES holding up a lot stronger, but we do have on that high just there, we did put an SMT with the 932 high. And that is the next signature I want to talk about. So at this point, we've put an SMT, we've respected this wick, we've showed bearish order flow, we have not hit the draw yet, and we've now put in this up closing candle, which you could argue was enticing traders long. So now we have this nice bearish order block. Displaced lower, SMT confirms that is a nice order block, and we can use that. And we start climbing back up after just tapping this low and falling short of our 23k draw, and below that, but a minimum 23k. And so this is where I should have been very confident and thinking, okay, this looks really good. I'm now going to mark out the bearish order block like so, and I want to get short somewhere within this range. So the next thing I'd be looking at is how we have levels such as the 20s, 50s, 80s, and big figures. And I usually just put a little line like that just to visually see it. You can see we already ran above the 80s up there, and we have the 20s sitting just down here. And I like the fact that when we just ran back above it here, we just placed through it quite hard. But I'm very aware that that's usually the area that I look to get involved in a trade, is at one of these key levels. But within this range should have been all I needed. So we rally up, and as we tapped into that, I did get short, and then I chickened out, essentially. Get this nice movement lower, and it still doesn't quite hit that our draw. So there's still plenty of reason to be getting in. And then I liked the fact that we're leaving these long wicks. This is kind of what I was wanting to see, is some really long wicks that suggest that it looks like a bullish rejection, and traders will now trying to be getting long when I know it's still bearish. So we then return back up into the order block, and I just wasn't really seeing it clearly at this point. I knew I wanted it to go lower. I didn't know if we would run up into these highs or not. ES was just consolidating like this. But really I should have just been more dialed in on, if I get rid of all these lines real quick, they're a bit distracting. Don't need that either, all that. Or 8:30, or midnight, we know where those are. Yeah, I didn't have this marked out, but I was aware of that being the order block, and that there was SMT on the highs, but I wasn't really thinking in the correct way about it, that we are in a sell program, we haven't hit the target yet, and that we're showing bearish order flow with the SMT, respecting this wick, leaving the breakaway gap, leaving the long wick plus displacement. And so I should have been very confident about this order block holding. We've already been holding it, and so this would be the perfect place to get short. We then sell off again, and right here I was looking at it and I was thinking, oh, I want to get in short now. And so I looked at the 15 seconds charts, and I was thinking, well, ideally I should have got short up at the order block, which is correct. But I thought, well, worst case, I could use this order block. If I mark that out there, on the 15-second chart, and we didn't hit it. We engineered some highs just above it, and I was thinking, okay, cool, if it comes up, takes us out one more time, and swoops into that order block, then I'll use that as my short entry. And because we still hadn't hit that 23k level, so at this point, like, I'm thinking, okay, this looks, I really like this long wick narrative, these long wicks, but at the same time, I recognize we're already at a deep discounts from where we started and where I think, we're going at a minimum. Sure, we could go a lot lower, but I don't want to be selling down here, with that being one of my main reasons for taking the trade. And then obviously there's all this down here, but I could easily drop down to here and run back up. So I figured, well, maybe it's going to create a long wick, and then maybe it'll give me even better narrative by running up here and then stalling and then selling off. And then that would have been the ideal trade. But I did see this order block and I thought, well, that could also be good. And I actually put in the order for a short, like a limit order, then I cancelled it, then I put it in again, then I cancelled it again. And it didn't end up hitting that anyway, as it did swoop out the high once again. And really, this right here should have been the entry. Sure, this is a 15-second order block, but at the same time, the inefficiency, like, really this is all very balanced. And if you draw out this old swing low, you can see that's likely what we were referencing, is that sell side delivery, buy side, sell side, and then just that's all sell side because we never took out a high in this area until here. So now from this low to this high, that's your inefficiency. And that's likely what we referenced as opposed to the order block. And as you can see, that's literally just the, I just marked out the 1 minute fair value gap precisely. So yeah, we're just referencing a 1 minute fair value gap essentially, rather than this being I want to hit this 15-second candle open, because it's not really a thing. And yeah, sells off. And at this point, I'm essentially done for the day, having hit max loss and missing out on this lovely move. So really the core issue is that, yes, I'm really good at finding frameworks. I'm really good at coming up with a narrative behind a trade and knowing a likely draw on liquidity. And then when it comes time to execute, I do have entry models, but I don't like entry techniques and specifics for the entry. But then at this point, when price is moving and it's dropping down like this, I don't know which one I should be reaching for. I'm just watching it thinking, okay, well, maybe I'll wait for this to play out, or like what should I be looking for? Like, what's my entry technique going to be? I think one way that I've seen people look at it that seems to work well for them is just trading order flow. So if we're going from destination A to destination B, then bearish order flow will hold until we reach destination B. And so then they're looking for, okay, fair value gap, want to see those hold, want to see the wick hold, bearish order block, that should hold. We're now below this bearish order block, that should hold, and so on. And that seems to work for a lot of people. And the same thing here. Make a low, consolidate, take it out, and sell off. So all this time, bearish order flow was holding perfectly well. There's nothing wrong with it at all. Closing above the order block open obviously isn't the most ideal, but it's within that order block range and respecting the mean threshold really nicely. So maybe I need to adjust the way that I trade from trying to say, okay, what entry model am I going to use? Like, I'm going to use the wick CE entry model. So I'm going to go short on this wick CE once we retrace above and close back below, which didn't end up happening here. Let's say that has been across like that, and we're taking out this high, then close the candle right below the midpoint. I could have shorted that. But rather than looking for that specifically to happen, which it could, and I'd take it, maybe I should be just trade. My entry model should be just bearish order flow. So follow the bearish order flow, because that's essentially how Michael's always taught to use PD arrays. Is like you have your draw on liquidity, and then align that with time of day, and align that with the PD arrays and how they should hold within that order flow. That's where intermediate term lows come in super useful. That's because if we put in an intermediate term low or intermediate term high, then that one gets taken out if we're going to continue bullishly. And when it does, that means that we're nearing the end of the trend and we'll turn around. So yeah, it's just good to get some thoughts out. I don't know if I achieved very much. I was talking about this. Obviously, it's a very beautiful setup, and I really like it. The regular trading hour narrative kind of stuff has been working incredibly beautifully recently. Even yesterday with the same kind of thing. I think we had where is 9:30? So yeah, 9:30 was exactly the same essentially. It was literally the same. Big gap up, and then we hit our key level, got SMT on the highs, and then had this aggressive sell-off. And then once again, I was waiting for a enticing move higher, so people would trail their stops. And that never really happened through here, and then eventually it kind of happened here, but then I didn't sell up here. And then when we sold off again and then pulled back into the range, I now thought, okay, well, maybe this is the model I was looking for. But then maybe it already played out here, maybe it didn't. And then I see that we're closing above the main threshold of this bearish order block. And so I start second guessing it, and I get in short, get a nice entry, then we're consolidating. I'm like, oh, well, it's already made relative equal highs. It's disrespecting the bearish order block. We've already hit this, and this could, you could consider this was the target for my regular trading hour stops model. Regular trading hour trailed stops model. That could have actually been it already playing out, and so maybe this isn't it, maybe it is, and the bearish order flow isn't holding, so I basically got out of the position. And that's how that day ended as well. So I think not having enough clarity of what actually constitutes the regular trading hour trailed stops model was the issue in this scenario, because I wasn't sure, maybe it's already played out because we already had this rally here. I think it should be more discretionary than that, in saying that if I think that this low makes a lot of sense for us to draw back down to, because it looks like we really did entice people along here, then I can say, okay, this is going to be my model. I don't care about what's happened over here. This is the low that I want. I should be able to say that. But then also recognizing the fact that, okay, sure, the order flow isn't particularly weak just here, but that doesn't mean we're going to just straight away reverse. It just indicates a impending reversal, which happens right here. It comes back up. So I think the key things for the regular trading hour stop model is, because it's very much narrative based, it's saying, hey, there's a big gap up, I want to see an area for people to trail their stops and then for us to punish them. Then that's not necessarily going to be the first swing low that forms, or the first this or that. It's really narrative based. And that's where having a long wick like that and a rally up like that makes a lot of sense. And then we got this nice rejection from this high. I was just getting thrown off by the fact we disrespected the main threshold of the order block and left the relative equal highs. which did kind of throw me off. So I think in future that what I need to remember is, for one, I get to choose what the narrative is and what narrative like constitutes that to be the draw. And then on top of that, the next thing I need to remember is that if we are disrespecting order flow like here, then I want to not get shaken out just for that being the only reason. And also it doesn't mean, okay, jam your stop up to like instantly jam it up. But it's just, okay, take in that information, and when we do make a new low, we'll take out any significant sell sides, such as even these smooth lows down here. Then you want to be more aggressive with your stop, and then not looking to, try and hold a runner and get stopped at break even or anything like that. So yeah, that's all about dirt. Last thing I want to mention that I need to work on, another cool model that I've been developing is when we have a clear draw on liquidity, such as this high over here, we then pull just short of it and consolidate. I see that as retail are now selling the pullback, and as we make these lower highs, smart money is now buying from retail who is selling. And there can also be, if this was an old resistance level, then you can imagine retail traders selling as we make these lower highs and find resistance there. Smart money is buying in this area, making this an area of accumulation. Then we draw that across to the right, and you can tell that, okay, now we're heading back up. This is now reaccumulation in that area of old accumulation. And then we get that nice run up. So this is just something I tape read. And we had the pullback after failing to hit the buy side pull up here. Pull back into the same previous area of accumulation. I've just marked out this highest up closing range from that work up to the high, which I assume could be a way to define risk, but I don't actually know for sure. I need to actually backtest it more. On gold, it's kind of a bit different as well because it can sometimes spike a little bit below it. But yeah, pulling back nicely into that. And I just put on this risk reward tool and just wanted to tape read. And one of the things that I want to be developing as far as my trade management goes is, when do I go break even? When do I take risk off the table? And am I happy with that? And I just wanted to tape read, okay, what happens if I actually, once we hit the opening price, I go break even? Because from the back testing of my 3-drive model, the 3-drive pattern entry model that I was using, it seems to be very consistent that once we hit the opening price, if I was right on the expansion of the hourly candle, my break-even wouldn't get hit. So if I made that a very standard rule and I didn't get upset when it did take me out, that would work perfectly fine. As you can see, once we hit the opening price right there, it never came back to my break-even, and we got this nice run up high. What tends to happen, however, is, let's say I was buying this down here. Let's say I bought this low for some reason, and then it goes up and hits the break-even level, that level there, or let's say, that's a bad example actually. Let's say for some reason I decide that I'll buy this bullish order block. So I draw that out, I'm like, cool, I'm going to buy that bullish order block with a stop loss below it. And then it gets this nice reaction, goes straight back, hits the opening price. But because I decide not to go break even, I'm like, oh no, just it feels too close to go break even. I'll just leave it a bit longer. And it comes down and gives me a full stop out. And that's, yeah, that does happen. Like, it's and it can be frustrating as well. Like, let's say there's another example. I might have bought here. I'm like, cool, and I'm gonna put a stop just there, and then it hits the opening price, and then rather than going break even, I'm like, oh, I'll just give it a bit more room. and it'll pull back down and then stop me out at a full stop out. And that's just because it didn't go break even. And I mean, in these particular scenarios that I've just shown you, they were all actually bullish, so it probably would have won. I mean, I would have probably been fine. But in a situation where I'm entirely wrong, such as what's a good example? Anyway, you get the idea. But yeah, in a scenario where I'm completely wrong, let's say if I was to just go short here instead, so I shorted this, whatever, and I put a stop up here, and then all of a sudden we go straight back down, we hit the midnight the opening price, and like, oh cool. Rather than going break even, because maybe I got my fill over here, I leave my stop loss where it is, and then it comes and stops me out. But however, if I had gone break even, as soon as we hit that opening price, it's now a risk-free trade. And yes, it might continue. And if I'm correct on this being the hourly expansion, then it probably would have never come back. But then if it does come back, I don't lose anything, and it's indicating that I'm probably wrong anyway. So I want to be more comfortable with doing that, and I'm really happy with how I did that here. I know it was literally just a tape read, but I still need to, congratulate myself for doing the right thing in the right places, which is I had a trade idea, had a thesis, and then as soon as we hit the opening price, I saw that, okay, now we're going to break even. If I'm correct, it shouldn't need to come back down there. And then that was rewarded nicely with this nice rally up into the high. So that's something I need to work on as well, is making less decisions. That's one thing that happened, I think, yesterday or today. I remember journaling it as it happened on my live screenshots, that I literally made like 5 decisions in one area. I think it was actually yesterday. I think it was probably in this area here. I made like 5 or 6 trading decisions when there should have only been like maybe 2 maximum. And there's just such a waste of mental equity and mental capital that it's no wonder that I ended up getting relatively tilted on this day. Simply because I was trying to make like, I think, yeah, that's what it was. It was, do I trail my stop or not? I had my stop loss, obviously. After this drop back down, I could move my stop to about here or so. And then as we consolidated in here, it's like, oh, do I move my stop loss down or up or down? And every time I've got these down closing candles and up closing candles, I was trying to change my mind 100 times. Then eventually I realized that, okay, that's just a complete waste of mental capital. I'm just going to leave my stop loss there. And then I closed out the trade, obviously. But making so many decisions all at once, that is very, very unhelpful. And it's just burning through mental capital. So what this would do, if I did implement a very systematic, once we hit this opening price, I always go break even, no matter what. Like if I made it as simple as that, that would, reduce the amount of decisions I make significantly. So that's something else that I would like to keep in mind for sure. So that'll do for this review. Gold was interesting today as well. I'll just say one very, very short thing on gold, and then I'm all done. I'm not looking to do any deep review on gold at all. And I fell one handle. I fell 2 points short of my where I was interested in along. But yeah, so on gold, we have midnight open down here. Did we ever hit midnight open throughout London session? No. So we were being held as a premium. This was not a good area to be buying. Eventually we did hit midnight open in this area, which was a nice long. And then down here as well, this was also a nice long. But at this point already, we were beginning to break intermediate term lows and just not look that clean. So we did hit EQ right here. We then broke that low again. That's where it started looking, okay, this is actually looking a bit dodgy. But the key thing I want to mention is when we have minute open down here, and we make that level, and then we never return to it in this entire area. We never return back down to that midnight level. This is all a premium, so like there's no need to be looking for longs in here. And then eventually we did sell off and hit that level like such. But it was just really interesting to see how that played out, because the same thing I think happened the day before, or earlier in the week anyway, where we had midnight and then we're just consolidating above it before moving higher. And there's a really clean example of that back here. So in this area, we have midnight open sitting right here. So that's midnight open. And then the exact same thing, we rally up to a premium, and this entire time we're just ranging, having these enticing rallies and just ranging around, but we never dropped down into here, and so all this was never going to go very far. Eventually we drop down into that midnight open, take out the sell side pull down there, consolidate within this midnight opening range, and then eventually continue higher from that. So a good way to filter trades anyway. That'll do for this review.